So here we go with the concepts that we studied in last lecture. Let's just look at the examples of all these elements once over again. So starting off with the assets, because assets are the economic resources of a business, and these basically provide business the economic benefit in the subsequent years or in future. The categories of these assets are, assets can be short term, assets can be long term, assets can be tangible or intangible. For short term, you need to remember that in short term assets, we basically have cash, which is frequently changing and is, changing on a daily basis. The value of cash doesn't remain the same every day. So cash is there as a very short term and a very quick asset. We also have receivables, which we'll study or we'll cover in today's lecture. We also have the goods or inventory, which is again categorized as short term because inventory is consumed on a daily basis in the production processes. And this inventory or the concept of goods or inventory will be covered in today's lecture as well. Then we have long-term assets, which basically include all the assets which provide you benefit for more than a year, and this include your furniture, equipment, building, land, or more of such assets. Vehicle can also be there. So then we also have tangible and intangible category. Tangible means physical assets, which you can see or touch, which are physically present, like building and your equipment, etc. But for intangible, we have copyrights, patents, or exclusive rights that you have acquired by paying something, the legal agreements between parties. All such can be categorized as your intangibles. On the other hand, we have, the liabilities. Again, we divided the liabilities into two categories. Current liability, that means short-term liabilities, which you need to pay off within 1 year, which basically you are obligated to pay off within one accounting year. Examples can be payables, short-term loans, your accrued expenses. That means the expenses or bills that you haven't paid yet and are liable to pay them off within few days or few months. We also have non-current liabilities like the long-term liabilities, which include long-term loans, bank loans, or even the financial securities like bonds. That means if you have taken loan by issuing, or if you have taken or raised funds by issuing bonds. Bond is a basically debt instrument, and bonds are usually categorized as long-term debt instrument, which basically have their maturity or lifespan of 5 years, 10 years, or even more than that. The third element was capital or equity, owner's equity. In case of a sole proprietorship, single owner, the capital or equity is invested by one person who subsequently manages and controls the business. But in case of partnership, owners can be two or even more than two. Up until in a general partnership, there are 2 to 20 owners or partners. But in case of corporations, the owners or shareholders can be unlimited even, having minimum of 7 shareholders, but maximum can be unlimited in case of public corporations or public companies. So equity or amount of money invested by owner or owners in a business is termed, as capital or owner's equity simply. Fourth is the revenue, which is the money that you receive from your business, basically by actually doing the business, by selling the goods or services to your customers. So the money or the proceeds that you get from your customers against selling goods or services is termed as revenue. Lastly, we have expenses over here. Expenses are basically costs that you have incurred, that you have spent in order to generate your revenue. Expenses can be direct, expenses can be indirect. Direct means all those costs that you have incurred in order to produce some goods, in order to manufacture something. So all those are basically direct costs related to the production of the goods. Indirect includes all those costs which keeps the business operational and are not directly associated with the production of certain goods. Like we have rent, we have fuel charges, we may have administrative expenses, stationery related expenses, we have utility bills, etc. So all these are basically categorized as indirect expenses. So you need to remember few examples of expenses as well. Again, making sure that expenses are basically cash outflows or results in cash outflows, but expenses are recurring in nature as opposed to your investments in your assets. Assets also results in cash outflows, but you don't basically spend on your assets on a daily basis or a recurring basis. But as far as expenses are concerned, these are very regular and very recurring in nature. So moving on, as I earlier mentioned that this is basically series, you may term it as series 2 from the basic concept. So in this lecture, we'll basically cover the remaining of the basic terminologies. The first and the foremost one is the goods. What can be termed as a good or a merchandise for a business? Is there any special way to categorize or distinguish it from the rest of the purchased items? So we'll cover first of all this concept. Then we'll move towards what are the types or what actually is the definition of purchases. Fine. We'll also cover sales and its types. Then we'll move towards one of the important concepts of accounting or the modern accounting, which is based on accrual basis and which results in receivables and payables. We'll look into the definitions and examples of receivables and payables. Then we also have the concept of return inward and return outward. Lastly, we'll cover the accounting equation and profit and loss calculations as well. So, starting off with goods or merchandise, even it can be termed as inventory or stock. It refers to anything which is purchased by a business, by a trader for a resale purpose or with the intention of reselling it to the end customer and to generate revenue. So anything which is manufactured or anything which is purchased for resale purpose to generate revenue is termed as your goods or your merchandise. In simple terminology, it is also known to be, inventory or simply stock, which is held by a business for resale purpose. So it may be comprising of raw material, it may be comprising of a finished form of some product, but ultimately the purpose for keeping such sort of inventory is to resell it to the end customer. So we'll look over here with the simple example how we basically distinguish that how what is or what can be termed as good and what not. Suppose there is a pizza manufacturer or there is a pizza shop termed as Hot Pepper Pizza. I've given it a hypothetical name, definitely. But there are certain items that I have listed down, or you can see over here. We need to identify what can be termed as good for this pizza maker and what not. First of all, because the main business or main category of the business for this pizza maker is he is basically making or baking pizzas and selling it. So, first item is burger. Whether burger can be termed as a good for this pizza maker? Definitely not, because he is a pizza seller, not a burger seller. So the main item he is doing business in is pizza, not the burger. So burger is not the good or merchandise main item for resale purpose for this business. Second is cheese. Cheese is definitely one of the ingredients for making this pizza, so we can consider this as good or inventory or stock for this pizza maker. So cheese will become the part of the end product, which is pizza. So cheese is basically good for this pizza maker. Then we have flour. Flour definitely is used as one of the ingredients in pizza. So flour is again one of the items of goods for this pizza maker. Bicycle or any vehicle or motorbikes, these cannot be considered as good because this is not the end product which is held for resale purpose. Fine. So anything which is held for resale purpose or which will end up with the end customer to generate revenue will be termed as good. So bicycle or any sort of vehicles, even if they are kept for delivery purposes, delivering free delivery of pizzas in some of the businesses, those are basically assets or can be termed as assets because they are there for shops and they provide benefit to the shops or assist them to deliver the pizzas or any other item, but they are assets, not the goods. Clock is basically again one of the items. Maybe it is with hanging in the shop or pizza, cafe or restaurant. But again, it's an asset because it will not be, it will not end up with the end customer. It will not be resale to the customer. So clock is an asset, not the good. Pizza box is a good because we need to basically package a pizza in a pizza box. So it's merchandise, it can be termed as a good. Now let's look at the purchase and sale related concepts. Purchase refers to buying the goods, buying the supplies, buying the stock or inventory from your supplier in the raw form or maybe in the finished form if you are a trading business. So purchasing or buying anything from the supplier is termed as purchases. And there are two types of purchases: cash purchases and credit purchases. If you are basically buying the goods or merchandise or stock from your supplier and paying the money to the supplier on the spot, that will be termed as cash purchase. But in case that you are buying the inventory or buying the goods but promising to pay later, you have basically promised to pay the money later, it will be treated as liability because you are obligated to pay it off ultimately, but you have taken some time, or you took some time and you'll pay the money after a few days or months. So that will be the case of credit purchases, and credit purchases are treated as your liability. In other words, because we'll move towards the concepts of payables and receivables, credit purchases are your payables. That means you are obligated to pay them off. You need to pay them off in the future. Then again, similarly, we have the concept of sales, in which you basically sell the goods in order to generate the revenue to the end customer. Even selling goods or selling services can be termed as sales for the business. So again, sales are of two types. The first category is the cash sales, in which you are selling the goods and receiving money on spot from your customers. On the other hand, there are credit sales in which you have sold the goods and it ended up with the customer, but the customer promised to pay later or is basically obligated to pay you off in the future. So, receivables are your assets by definition and are, in other words, termed as receivables because you need to receive the amount in the future. So, receivables means you will receive the amount in future. Why it's categorized as asset? Because by definition, all those things which provides you benefit in future are your assets. So selling goods on credit and receiving money in future, that means you will receive the benefit in future. By definition, again, this sort of scenario will be your end up in new asset, which will be receivable. So you are generating receivables, which are your assets. Here we'll look at examples of cash versus credit purchases. The first example is, here you can see there is a person, Mr. Alberto, who purchased goods today but agreed to make the payment after 2 weeks. So is it a cash purchase or a credit purchase? Definitely, when you promise to pay after a certain time period and you're not paying on spot, it's a case of credit purchase. For the shop from which basically Mr. Alberto bought the goods, is categorizing it as credit sales. Second example is where Ahmed paid 4,800 to the shopkeeper for latest model of bicycle. This sort of scenario is cash purchase because the person who is purchasing the bicycle paid the money on spot. For the shop, it's the case of a cash sales. Fine. For Ahmed, it's cash purchase. Last example is where Carla bought so many party dresses from a boutique and paid $500 on the spot. Again, the word denotes it or says it all that it's a cash purchase. Carla basically cash purchased the dresses. So for the boutique, it would be a case of cash sales. So in these three examples, only the first example was of credit purchase or credit sale, but the rest of the two are the examples of cash purchase and cash sales. Fine. So as we earlier covered these two concepts, let's look at them once over again to get a better understanding that what can be termed as receivable and payable. The first thing is receivable. Selling things on credit generates your receivables. It's the money that the business will receive from its customers to whom the goods are sold on credit, and those customers from business perspective will be treated as the debtors of the business. Debtors are people or entities to whom the business sold the goods on credit, and the money from them will be received in future. So debtors are those people and entities. Receivables is an alternate terminology, but sometimes used synonymally, receivables and debtors. But there is a slight distinction as well. Debtors are actual people or entities who owes money to the business. But receivable is basically the record of the money, that how much money is to be received in future. So again, receivables or the amount that is basically that will be received from debtors in future will be treated as asset because the benefit is associated with some future date. So as long as you are receiving the benefit in any future date, it will be, it fits the definition of asset, so it will be treated as your asset. So do remember this thing that receivables are your assets. And earlier when I basically gave examples about current and non-current assets, I mentioned this thing that receivables are treated as current assets. That means short-term assets. If you have sold the goods on credit and you will receive money in some days or in some months, but again less than a year, within a year, so that will be treated as your current asset or short-term asset. So here I would again, reiterate this concept that receivables are your short-term assets, your current assets. Moving on, the next concept, which is payables, where basically you are selling goods on credit. So payables is associated with the concept of credit purchases, where receivable is associated with the concept of credit sales. So when you are basically purchasing goods on credit from a supplier and you agree to make the payment after some time, you are generating your payables, the amount which you are liable to pay off in the future. So do remember this thing that payables are treated as your liability. And talking about the goods or stock that you have purchased from your supplier on credit and generated the payables, you will make the payment in some days or in some weeks or let's say months, but again less than or within a year. So it will be part of your current liability. That means short-term liability. So again, I have an example. I have two examples here for you people to understand the concept of debtor and creditor again very well. The first example is where Aunt Martina is basically buying vegetables, or she is basically doing groceries from a supermarket on credit. See the word here, it's mentioned that it's basically credit purchase. From the Miss Aunt Martina angle. So when she's buying vegetables or groceries from supermarket on credit, Aunt Martina is basically a debtor, or she has become a debtor to the supermarket because she agreed to make the payment in future. For supermarket, Aunt Martina definitely is a debtor, but for Aunt Martina, or from her perspective, supermarket would be the creditor. Fine, because she is liable to pay the money to the creditor in future, that means to the supermarket. So in this scenario, Aunt Martina is debtor to the supermarket while supermarket is basically creditor to Aunt Martina. Again, taking another example, suppose if there is a successful businessman who needed additional funds for his business. So Mr. Carlos is basically a businessman who approached the bank for additional source of basically fund for his business. So in this scenario, bank would be creditor for Mr. Carlos, but for Mr. Carlos, bank is a creditor, and for bank, Mr. Carlos is a debtor. Fine. Bank has to receive money from Mr. Carlos, but Mr. Carlos has to pay the money in future to the bank. So bank is a creditor for Mr. Carlos, and Mr. Carlos is a debtor to the bank. Now let's look at another concept related to sales and purchase. Return inward and return outward. Return inward is sales return. When you have purchased the goods from the supplier and basically after purchasing the goods, you realize that these goods are not of certain quality or specifications to you mentioned earlier to the supplier. You are returning the goods back to the supplier. In that case, you are basically selling the goods back to the supplier, it will be termed as purchase return or simply return outward. But in case you have sold the goods to the customers and customers don't, basically like it, or they received some wrong item, or maybe the good was defective, they may claim to return it back to the business. And receiving the goods once sold to the customers, receiving it back again in the business will be termed as sales return. That means you have sold the goods previously, but those goods are again, returned by the customers. That would be, known as return inward. The goods are coming back in the business. So that's why we are calling it return inward. So when you are, returning back the goods to the supplier, that is basically return outward. When you are receiving back the goods from customers, it's return inward. So sales return and purchase return are the alternate terminologies which can also be used. So the reason for these returns can be that the goods may be not liked by the person who received it. The goods may be of, may, uh, have a, defect in them, or may be of poor quality or not according to a specific, quality or specification. So there can be any reason for this return from business angle or even from customer angle. Now let's look at one of the very important or the fundamental concepts on which whole accounting is based. It's accounting equation. Do recall that I have earlier, mentioned or earlier taught you about the accounting elements, 5 elements. Out of those 5 elements, 3 ends up in this accounting equation or forms the basic or fundamental accounting equation for any business. So we call it, basically that assets are always equal to your liabilities and owner's equity. This equation holds true in any case for any, even person or even entity or business. So whenever you want to start any business, you need some assets, and for purchasing those assets, you have only, or you can rely on only two sources of funds. Either it can be your own money or your own saving that you have invested in the business, which will be the capital or the capital investment, or you may call it owner's equity. So if that money is not enough, that means your savings or your own money isn't enough to buy the assets or required assets for the business, you definitely would go or, approach the other sources or external sources of funds or money. That means you'll ask others to give you money which you'll pay off, or you are obligated to pay it off in future. So definitely that would be liability or your debts, debt obligations. So there are only two sources of funds. Either it's your own money or either you have taken it from someone else. So the money you have taken from someone else is your obligation or your debt obligation which you need to pay off in future. So here again you have two sources of funds. Using those sources you'll purchase all your resources which you require to start or, operate a business with. So assets, this accounting equation is also termed to be assets are always equal to claims against assets. Why it's termed as claims? Because your the end claims or the ultimate claims on the assets or the assets value is of your creditors which gave you money. If you are not going to pay them back, they'll have the claim on the assets. You need to sell a particular asset to pay the money back to your creditors, so they have the claim. I'll give another example. Suppose you have taken some asset from bank, let it be some car. You will pay the money back to the bank in the form of installments. In case you default on any of the installment, or you continuously are ignoring to pay back the installment or the money back to the bank will seize your asset, seize your car, and it will sell it and retrieve its money back. That's why we call it claims on assets. So your creditors have claims on your assets, and your owners, because owners have also invested in the business, with the owner's money and with the creditor's money, you have purchased your assets. So the end claim on these assets, in case the assets are sold in the market in case of bankruptcy or liquidation, the money will be given back to the creditors and the owners. So looking at an example, a very simplest example over here, suppose the assets that you have with you for your business worth 1 lakh. For generating this 1 lakh, you invested 60,000 of your own money and you took 40,000 of loans. So the accounting equation here you can see is in balance. Fine. We'll also practice over here with the help of these, two examples. I have two set of statements over here. I have a few examples or a few values over here. So let's practice it. The first one says that suppose there are these three assets over here. I can do recall that I have mentioned these items earlier in your assets, examples of assets. Cash is an asset, receivable is an asset. Again, cash and receivable both are current assets. Equipment or any furniture, land or long-term assets. So here we have three assets in the first example. Cash of 20,000 is with the business. Receivable, that means goods are sold to the customer, but money worth 80,000 is to be received in the near future. So again, that is an asset. Equipment is of 1 lakh and 80,000 with the business. So we need to have a total of all these values. How much assets a business have in here? We need to aggregate it. So basically, it aggregates to 2 lakh and 80,000. So assets worth 2,80,000 in this very first example. On the other hand, we have liabilities in which we have payables basically of 80,000. We need to calculate or we need to ascertain the value of the capital. How much money was invested by the owner? What was the amount which was shared by the owner in this business? So in this example, we'll offset liabilities from the total value of assets. So if we subtract 80,000 from 2,80,000 of assets, we'll be left with 2 lakh. That means the value of the capital was 2 lakh. See? So when you again take a total of both the sides, because assets are equal to liabilities and capital, you'll have 2,80,000 on both the sides. So we basically calculated the missing value in this example, which was capital, and we found it to be 2 lakh. Moving on towards the next example, in which there are again some assets listed over here, and we have payables, we also have capital, but we are basically having one missing value on the asset side, which is building. Fine, and we need to assert in this value right now. For this sort of example, again, the way to basically offset and find the missing value is to take a total of available balances on both the sides. On the left hand side of the equation, I'm talking about the accounting equation. On the left hand side of this equation, we are only having two values and one value is missing. But the two values we have amounts up to 1 lakh, 40,000 of cash and 60,000 of receivables. We are having 1 lakh. On the right hand side, we have capital of 2 lakh and liabilities of 1 lakh. So we'll take an aggregate of this right hand side as well, which amounts up to 3 lakh. So on left hand side, we are having 1 lakh. On right hand side, we are having 3 lakh. If we offset 1 lakh from 3 lakh, we'll be left with 2 lakh. So we can say that the value of building is 2 lakh in order to make both sides equal. So when we have 2 lakh of building and 40,000 of cash, 60,000 of receivable, that will amount up to 3 lakh, which will be equal to the right hand side of payables, that means liabilities and capital. So this is how you'll calculate or you can ascertain the missing values in the accounting equation as well. And these sort of short questions may become the part of your assessments or quizzes or even exams. So you need to practice those sort of questions on your own as well. Next, we'll move towards the profit and loss, how profit and loss is calculated. Again, do recall the remaining two elements of accounting because we worked with three elements so far and we formed or we came up with this fundamental accounting equation. And we also calculate missing values in that accounting equation. So the remaining two items among the five elements of accounting are revenue and expenses. Revenue is the money received from customers by selling them goods or services. Expenses are costs that you have incurred. So in order to ascertain whether you are in profit or loss, you need to offset or you need to subtract all your expenses from your revenue, from your generated sales. So when your revenue is greater than your expenses, you are in profit, and vice versa, it will be a loss. If your revenue or sale proceeds are lesser compared to all expenses or costs that you have spent or incurred, you are in loss. We'll understand this through an example as well. We have two scenarios over here. In the first scenario, suppose there is a person, Mr. John, and he's expecting huge net profit, huge profit. His revenue for the month amounts up to $4,500, while his expenses amounts up to 6,700. We need to inform Mr. John whether he is in profit or loss. Do recall that I earlier mentioned if revenues are greater than expenses, only then you are in profit. So in this scenario, it's pretty much clear that his revenue is lesser compared to the expenses. Definitely, he is in loss or he earned himself a loss. So in the second example, Mr. Gonzalez earned huge bucks and his earning or his revenue amounts up to $8,900. He sold herbal medicines and earned $8,900. His cost for producing this herbal medicine amounts up to 6,500. So cost means expenses and earning means revenue. So if you subtract all these costs of 6,500 from his revenue, you'll get to know whether he's in profit or loss. So again, we can clearly say that his revenue is greater than his cost or his expenses, he is in profit. Fine. So this situation was the situation where Mr. Gonzalez is basically having a profit. So again, making sure that some of you might have a confusion that revenue or income can be termed as profit as well. No, it's not the case. In order to get to know the profit or loss, you need to subtract revenue or you need to subtract the expenses from your revenue. You need to offset the two items, the two elements. Only then you will get to know about the profit or loss.